Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it if you like, but that's the main point to take away. All right, well, along with all the other crazy news that's going on, Moody downgraded the banking sector. So interested to hear Rob's thoughts around that and very excited to interact with you all. So thank you for joining us for this live session. And at this moment in time, I'll introduce the man of the hour, and that's Rob Roy.
Thanks, Zach. Hey, everybody, and welcome to this week's TradeFinder Live. Obviously, an awful lot to talk about. I'll probably be talking quite fast so that we can hopefully get through everything and still have some time for the Q&A at the end. I'm going to start by going back to last Thursday. We did our insiders meeting. Insiders meeting is what we do every Thursday night for our alert subscribers at ewotrader.com. And we had talked about the intraday turnaround that occurred on Thursday. Market was trending to the upside, nice rally going on until around midday, and then something happened where it turned and we went to the downside and on big volume. It was just a steady move lower. And so we were talking about it at that time. I didn't know the SV. We found out obviously that people had gotten a hold of the fact of the SVB news, and that turned things, and it just turned everything around. And so that was the big turnaround that occurred on Thursday right here. This is the bar. And then as you can see that had big volume, and we've had big volume since on Friday. And then Janet Yellen comes out on Friday and says, and we're watching a few other banks too, which I thought was completely irresponsible. I couldn't see what the motivation was to come out and make a comment like that. And so Friday, rough day as well, also on big volume. And so then we get into the weekend and you start hearing about Signature Bank, all this other stuff that was going on. That news actually came out before the open on Monday. But then the Federal Reserve came out on Sunday night and said, all right, we're going to backstop all those unprotected, deposits up to 250,000 are covered by the FDIC. Anything above 250,000 is uninsured, and they were going to backstop all those. Futures rallied, like Dow was up like 400 points, etc. Then that Signature Bank news came out, erased all of the gains in the futures, and nobody knew what was going to happen on Monday. Most people felt like, okay, that's going to calm everything down. And then, as Zach said, Moody's is now today came out and downgraded the banking sector from stable to negative. Market just didn't even pay attention to that. We were rallying early, then we gave most of it up, and then had a late rally at the end of the day, and that's how we finished the day's move to the upside. So craziness everywhere, but downgrading the banking sector. We talked a lot about this, and our subscribers have asked us about this. We've talked about it on previous trade finders as well, about black swans. And going all the way back to 2020 when we did Black Swan, and we kind of got it right on the whole COVID thing. Like, there's this little virus in China that we probably ought to keep an eye on. Turned out obviously to be a really big deal. And we came up with a couple of scenarios, war related, some other things. I don't know that anybody saw another potential GFC, global financial crisis, on the horizon, but that's what we're looking at if things don't calm down. And it doesn't have to be that these financial institutions are in trouble. Just talking to some bankers yesterday on T-bill rates, bond rates, et cetera. And, there's a par, and then there's trading on a discount when you have T-bills through brokerage accounts, et cetera. Then if people want to get out of them, they're willing to sell them at a discount. When prices, financial institutions have a lot of these in their portfolio. The whole gist of this, you're wondering, how in the world did this happen? How did we get to the point where the financial sector is this upside down? The move in interest rates, I'm just going to go ahead and switch the screen. I'll come back and show you the charts and the technicals of where we are. But this move in rates caught some banks off guard. a little bit. They were too heavily invested, if you will. And so when they have to create liquidity, that's why you hear the run on the banks being such a problem. When they have to create liquidity, and if rates have gone up, prices go down, right? Prices and yields go in inverse direction. So if they have a whole portfolio of these and they need to sell them so that they can meet redemption requirements, they're selling them at a loss. And if you have enough of those and you're selling at a loss, all of a sudden you become insolvent. That's the fear factor that comes in on the run of the banks. That's why the FDIC came in and said they were going to insure the deposits. You want people running to the window to take them out. So you could actually have banks that are really okay position, but you have a situation where you hold a T-bill to maturity, whatever, you get the face value at maturity. But in the meantime, they trade, trading on the secondary market, et cetera. And so prices go down, they can show losses on there. And if they're forced to sell when they're showing a loss, then you can see where the liquidity crunch can come in. If you're curious as to how the banking sector can get in trouble like this, especially after we've been hearing since the great financial crisis, all these stress tests that the Federal Reserve has put banks through, et cetera. It wasn't the big banks so far that are in trouble. And those are the only ones that have gone through the Federal Reserve stress test. These intermediate sized banks weren't subject to that. They didn't have to go through the stress test. They don't have to meet those requirements that came out post the great financial crisis. And so, we don't know what could happen from here. It's really going to be interesting to see how the next few weeks play out. So I thought I'd just share a little commentary there on where things are. And you can see how rates have tanked here. And remember when we were talking about rates coming down and the fact that if rates came down, that would be a good thing, unless it was rates coming down because prices were going up, because money was leaving the equities market out of fear and moving into the bond market, prices going up, yields and rates going down. That's the one reason we didn't want rates to go down, money leaving the equities market. And that's what's going on. That's why you're seeing these rates going down like this. Money's pouring into the bond market, et cetera, as a safe haven. So we had these boom, massive moves. You can see you don't often get moves like that. Here we're going back a ways, and you don't see anything like what we just saw over the past few trading days with these big gaps to the downside. Now we came back a bit today. Things did calm down a little bit. It was nice to see because it was kind of a little spooky when we had this really nice rally up until the early afternoon, and then it rolled over and just gave almost all of it back. To see that last little blip to the upside, you almost have to wonder. They've done it before. They've admitted doing it before. Is the Federal Reserve buying the S&P in times of problems? They've stepped in and done that. They called it the Fed put. And you have to wonder if that's what's going on. I don't know that and don't have any information on that. It's pure speculation. But it's just, it could have been a bloodbath the start this week. And fortunately, it hasn't been, but holy cow, an awful lot has been going on to talk about. We got Credit Suisse in trouble, but we already knew they were in trouble. They're a big one, but that SVB bank was a big one to just become insolvent so fast. And it had to do with rumors coming out and then the run on depositors wanting to take their money out, et cetera. And then you don't have the money and you can't get it. So craziness. So let's go back and look at the S&P because this is wild too, the chart of the S&P. And I posted this commentary. I wanted to show it to you real quick on our website. This is ewotrader.com. And here's where I was talking to our subscribers about what was going on. Here's this chart that I shared with them. I'm going to break that down with you because without reading all the commentary that I made, I'm going to go through and share that with y'all tonight. It looks like lines everywhere. And like, what can you make of that? What in the world is going on there? So let's go back and go through and see what it is. And what I was saying was that, believe it or not, this large zigzag pattern that we've been talking about for quite some time is still intact. So we went up to the 61.8% level, and we formed a triangle. Now, this is just Elliott wave Fibonacci stuff everywhere out of these patterns. So there's the big zigzag pattern. And then right at the 61.8% level is where we had that triangle. And know where the point of the triangle is, exactly at the 61.8% fib level. And so there's your breakdown out of the triangle. There's the impulse move. And we had a downward zigzag that actually, watch where this hit. This downward zigzag, boom, exactly to the 100%. You want to see why we trade Elliott wave and talk about zigzags and Fibonacci all the time? Look at that. Look where the low was yesterday, exactly at the 100% extension. And we've also been talking about this 380 level. We were talking about that Thursday night in Insiders of could this 380 level hold after that intraday reversal that occurred on Thursday. That needs to hold. And that was in my commentary that if that level holds with the completion of the zigzag, believe it or not, the upward zigzag is still intact. It's nothing more than a complex C wave at this point, provided that this 380 level holds. If we break below that, where all this congestion is, and we take out this B level here, where there's not much room to the 61.8% fib level, and after that, it's done. It's all over with. We're going back down here to the start. That's what happens when a pattern breaks down, is you retrace the entire impulse. So if we don't hold in this area right here, highly likely that we're going to come down and test that low down around 350. That's the importance of this holding. If it does hold and the completion of this downward zigzag, so I'm going to take that one back off, this upward zigzag is still qualified. It's still in play, and you could chalk it up to nothing more than a complex C wave, an odd complex C wave to say the least. Not often do you get a complex C wave that has a completed downward zigzag in it, but that's exactly what happened. And I've shown you how it hit the levels spot on. Just unbelievable how it hit that 100% level and turned basically on a dime as soon as it hit it. You can see the bar. You can see where we opened. You can see where we closed. It's exactly what happened throughout the day. Now, the other thing that I want to throw into the mix, and we have to examine this possibility due to the fact that we went up to where that A wave was and came back down. The possibility that this 380 level holds and we only go back to the 61.8% level, creating what's that? That's a flat, right? If that occurred, then we'd have all three of the corrective patterns all in the same C wave. So we'd have zigzag, triangle, and a flat, all within the exact same C wave. So, Elliott wave everywhere. If you're new to Elliott wave, welcome. This stuff will really help you understand what's going on with price action in the markets. So we have to keep that in mind. Hopefully this holds and moves to the upside. To have a big rally after Moody's just downgraded the banking sector, I don't know. The Federal Reserve would have to come in and buy an awful lot of S&P to create short covering, I think, to make that come to be. But we have to respect the fact that it's still qualified. It's still a possibility with all the nuttiness and craziness that's gone on over the past 4 trading days and then over the weekend. This upward zigzag pattern is still qualified. It's yet to become disqualified. It could still go up and hit that 100% extension. I get that it seems less likely with everything that's going on, but sometimes that's why things happen. Perhaps too many people were getting bullish and too many people were on that bullish side. And that could be a reason now that people are scared, worried, fear, blood in the streets, Warren Buffett, that's the best time to buy, right? You buy when everybody else is fearful. That's how you make money. You got to have the guts to step in when everybody else is running for the exits. It's not an easy thing to do. So I also thought I would show you a chart of the VIX. I don't really have much else to say here other than we just have to keep an eye on where things go from here. So far, so good on that 380 level holding. And if it doesn't, if we retrace back down, then watch out below. I don't think that's quite Katie bar the door there, Zach, because it's just down here around 350, 360, but it would certainly not feel good for everyone that's bullish on the market. So let's take a look at the VIX, and we'll see that where we were talking, we talked about this I think we talked about this in TradeFinder as well, but we definitely talked about it Thursday night in Insiders, that with the VIX down here, hanging around in this low area around the 1819 bottom, where was the room for the rally for that C wave extension? The room on the VIX, right? Because if the market goes up, normally the VIX goes down. But if we're at all this support level, where is the room for this C wave extension to go all the way up from the VIX? When you get down here, the likelihood is more that you're going to move to the upside in the VIX. And one of the things we talked about Thursday night was here we were right in this area, and it said that there we are right there. That's where we were Thursday, and said if we break above that 24 level, look out, because there's nothing above here. So, and that proved to be exactly what happened. You break above that level and it works on the VIX just like it does anything else. Support, resistance, there was no resistance. So it was clean air for the VIX to just explode to the upside, which it did. So even on the close today with the rally, we are around the 24 level. So now we have some room where we could start to possibly meander down on the VIX and have some room for the S&P to go back up. However, when you look at it, you're like, okay, but we're way below where we were before. So we're up in here talking about where's the room on the VIX. Now we have some room on the VIX, but we're way below where we were before. So if the market was to come back up and create this flat here, how much of the VIX would be left at that point in time? Lots of unanswered questions. Unbelievably difficult market to trade right now when you have this kind of unknowns. The market doesn't like uncertainty. And when we saw the futures erase Sunday night, just like that, as soon as the news of Signature Bank came out, that 400-point Dow futures rally was just wiped away. You see how fast things can go. We have one of our subscribers that talks a lot about those zero DTE options, and there's been some talk about it. It seemed like the possibility is remote, right? Everybody likes to, not everybody, but a lot of people like to market fear. It just seems to work when people put out fear mongering type things. It gets a lot of views. And one of the things that they were talking about is how these zero DTE options could create like a flash crash to the downside. Like if the S&P were to drop 5% then in a day, that it could actually be exacerbated by these zero DTE options. I'm going to do a whole segment on those coming up, so watch for that in the not too distant future. It could turn a 5% move in the S&P to a 25% move. All right, first of all, we have to go back and say a 5% move in one day. That's a massive flash crash already in the first place, right? So that's a big, huge move to the downside. Could it happen? Yeah, it could happen. But it also has to happen based on this data in a very short period of time, like 30 minutes. Like you have to have a big flash crash move. And if that were to happen because of these zero DTE options, it could exacerbate that move, and we could have a really ugly day going back to Black Friday, going back to 1929, et cetera, that one of those type of events. But as much as that garners headlines and everybody wants, oh gosh, what could that happen if you're the idea that is quite remote. Does it exist? Yeah, but it's really remote. So the possibility that happened seems slim. Now, probably ticked up a couple percentage points of possibility with what's gone on with the banks. What do you think would happen if one of the bigger banks, SVB was pretty big, but one of the big banks that have been undergoing the stress test, et cetera, if one of those were to go under again, a la like a Lehman Brothers, et cetera, type of thing, would that do it? Maybe. So anyway, if you were wondering about those, if you've heard about them, if you're curious, if you'd read some of those fear mongering stories that are out there, just wanted to share all that stuff with you. So wow, wild times in the market. This is why I was saying I'm going to try to talk fast so we still have some time for Q&A at the end. So here we are back to the bond market and those big gaps down. And where do we go? We came right back down here to support on bond rates, and we've held there so far. And to me, yeah, this is kind of what I wanted to see, but not under these circumstances. I did want to see rates back off a little bit because that's conducive to movement to the upside in the equities market, but not under these circumstances. You don't want bank failures to be causing this. You didn't want this to occur from a panic run into the bond market and out of the equities market for fear of risk. You don't want any of those scenarios occurring either. So we're down into an area where I'd like to see rates as far as being conducive to the equities market, but not in these circumstances. I don't think it carries the same weight as what I was talking about before. But nonetheless, here we are. And we look at the moving averages and we're still a little below the 10-day moving average. Perhaps we start to creep back up a little bit and normalize a little bit would be great. The more days that go by without any sort of contagion fear, and that's what was going on over the weekend. If you got any sort of financial news headlines or whatever, that it was contagion fear. You know, how far is this going to spread? How intertwined is it? How many other banks are involved? And Janet Yellen, to me, irresponsible comments of we're monitoring a few other banks without naming banks. What did she think that the average American was going to be thinking over the weekend? Is my bank one of the banks they're watching? That's what's going to be going through people's minds. I just could not believe it. That's one of those scenarios. You've all heard the story of why I watch the financial networks on mute, because something ridiculous was said and I threw something at my TV and broke it because of something ridiculous. That was one of those kind of moments where you just shake your head and wonder, think before you speak, especially when you're in a position of power like that. My soapbox speech, my opinion, nothing else. So take it for whatever that's worth. And then we take a look at the dollar, and you can see here the dollar is acting just fine. Which that's calming, right? We haven't seen anything wild going on with the dollar, no massive run to the upside. So at least there's not global panic yet of everybody running into the dollar. So far, so good on the dollar. That I think helps to, and I think that's really what's calmed things, because this is kind of wild with rates to see the dollar kind of stable. It's giving some insurance, especially assurance, not insurance. It's giving assurance around the world that, okay, we had some bad news. We know what's going on. And this all comes back to the Federal Reserve needed to step in and do this. We can spend hours talking about how, they created this scenario by keeping the easy money policy too long and inflation, and they didn't believe in inflation, kept saying it was transitory. And then we get big inflation. Now all of a sudden it has to come down immediately, and they're ready to move things to the downside. So we had decent numbers come out on CPI today. So that was good. And then the core CPI, those two were kind of in line, a little bit up, because now it's called shelter instead of housing because they put some other things in it. And because that's been strong, and that kept the number just a little bit higher, but coming down and in line. So now we have the super core, which is not just X food and energy. Now it's X food and energy and shelter. Makes you wonder, well, what's left in the number? What are they looking at if they're not looking at food, energy, or shelter? So if you don't count the house you're living in or apartment or wherever you're living, you don't count the food you eat, don't count the fuel you put in your car. None of those things count. You throw all those out. I don't know, again, could spend hours on all these things with soapbox speeches. So don't want to get into all that, but at least it's showing that the numbers are coming down. And now we're back to the end game here before we move on, is that a 25 basis point rate hike is now at 85% likelihood based on the Fed Fund futures. So not the 50 basis point that it looked like last week before all this kind of stuff started going on. So now it's backed off to 25 basis points, and it looks like that's probably where it's going to be. You get the Fed Fund futures showing an 85% likelihood of that. That's probably where we're going to be. And so I think the market handles that. That's been baked in. That's not going to shock the markets. I don't know how the market would have handled going up from 25, because that's what's been factored in for a while when there was some movement in the Fed Fund futures for a potential 50 basis point rate hike at the March meetings, back down to 25. And again, with that high of a percentage number, that's probably where we're going to be. All right, so all kinds of stuff to talk about. Obviously, now we have to get to the rest of the markets and see what's going on there. I showed you all those charts of the, and it's going to be interesting to see what's going on around the world, isn't it? And gosh, wait till you see Bitcoin and what is going on there. Is Bitcoin now a flight to safety? That's wild, isn't it? And we'll look at it in a little bit. If you haven't seen what's going on there, it's pretty interesting. So here's the Dow, not too terribly ugly here, but 320 levels got to hold, because there we are, nothing in the way. 320 is the last point. It's got to hold. We're okay right now, but look where we've relabeled. Do you see the relabeling on the down now? It's a 5-wave to the downside pattern, and we haven't had that. So that's a new pattern. That's not a positive thing. And it makes you look at this wave 5 and say, yeah, that's probably going to be an extended wave 5 if we continue. If we bounce up and create the 4 and come down there, it would be difficult for me to believe that we would stop there, with the fact that there's nothing in the way. So you have to wonder, is that where we're going to go on the wave 3 extension? Then we bounce in the 4 and go lower on the 5. There's a lot of unknowns, but this is a bit worrisome, that the Dow, which was once the market leader back here, September, October, was leading all the markets, is now relabeled to a 5-wave to the downside pattern. The S&P hasn't done that yet, but the Dow has. And then we talked about this. This was kind of calming on Thursday night, that the Qs had hung in there pretty well, and they still have. In fact, the Qs are still in a 5-wave to the upside pattern. Now, how do you got the Dow in a 5-wave to the downside pattern and the Qs in a 5-wave to the upside pattern? The last time this happened, we said you get these discombobulations. They don't last long. Eventually, the markets come back in line, and they will again. But which one's gonna win out? Is it going to be the Dow to the downside? Is everything going to flip and have 5-wave patterns to the downside? Or is it going to relabel again back to the upside following the Qs, which have been the market leader as we start looking towards rate cuts? Originally priced in 50 basis point rate cuts by the end of this year, now well into next year, with what's been going on. You have to wonder, with the banking sector, here's the thing that I was talking to people about over the weekend, is my fear, is that it could get to the point where we're very dependent on, if things get ugly enough. And gosh, we've been talking about this. Look at the yield curve. Look at the change. It's finally starting to change. I've been talking about this for a long time, with people trying to say it's different this time. It's never different this time. This has been one of the more dependable indicators in the history of trading, the 210 inversion leading to a recession. Now, look what happened to short rates. Look at the 6 months ticking up, really short term, ticking up. But we're coming down now on the 2-year a bit, and we're starting to go back up on the long end. That's healthy, that we're finally starting to turn here. Not this part, not the real short term. That's the panic, though. That's occurred from this panic over the last few days. That will even out. I suspect over the next few days, we won't see that kind of a tick up. And so perhaps we start to get more of a normalized yield curve. But now we're starting to see what the bond market has been warning us of for so long. And I always talked about, the bond market's larger than the equities market. Don't diss the bond market. And so many people were. And you can go back and look at the videos. I'm patting myself on the back a little bit here, because I've been singing this tune for a long time. You just can't discount one of the longest inversions in history and one of the most severe inversions in history. It's been screaming something's wrong for a long time, and now it's starting to come to fruition. We just don't know how bad it's going to get yet. When you look at the Qs, that makes you feel better, with that 5-wave to the upside pattern. The wave 4 only retraced 52%. It's just a 50% correction. It didn't even go to 61.8. And it's bounced back to the upside. And so if the Qs are the market leader, getting back above the 10-day moving average today on the close, that's, if you're bullish, here's where you want to hang your hat. This is what you're looking at, is saying, okay, the Qs are the leader now, because we're looking for rate cuts more than we are rate hikes. There may be 1 or 2 more rate hikes, but those rate cuts could start to come back in sooner if things get ugly, if we start to hear more banking issues, if the economy starts to really tank, et cetera. Perhaps that comes back in, and that would be good for the Qs. So this is where you want to live if you're bullish on the markets. You're following this chart and saying, I'm looking for that as to where things can go in the future, and I feel good about that. No doubt about it. That's a good looking upward wave 5 pattern, slightly discounted because of the downward 5-way pattern in the Dow, but we're talking about the Qs. That looks pretty good to me right now. So the IWM, as you can imagine, I had a rough time with all this. So who wants to be in small caps with all this fear? And we came down here right down to that 170 level, which was the support for so long. Between 170 and 190, we'd finally broken above 190, tested it a bit, looked like maybe we're going to try to run up to that 210 level. Never happened. And we had this series of lower highs here, which was probably telling us that, yeah, it's probably not going to happen. A bit of a descending triangle there, and boom, there was the big breakdown. You can see how oversold we were yesterday on the low, coming down to 170, rebounding a bit there, kind of a doji there for today, and just a little bit oversold still, but rapidly closing that gap with the 10-day moving average. So you'd have to say that we're probably firmly back in the range of 170 to 190 on the IWM for a while now. Hard to imagine that we turn around and run back up. Maybe we will, but man, I just think we need time now. That time has to go by without any more bad news in the banking and finance sector for people to start to feel a bit more comfortable. I really believe that. And so I just don't see this run right back to the upside occurring. So here's Bitcoin. And how interesting is it with all the negative publicity that the cryptos have been getting? All of them, look at that. Are people running into cryptos now because of fear of traditional banking? What a flip turnaround from all the rhetoric that's been with the risk involved, starting with the whole FTX debacle in the crypto world. Everything's just been so negative on Bitcoin and the cryptos, and they're flying to the upside. And you can see this big, huge move here. And the important thing is that we came down, we tested 20,000. That's where we said if we weren't able to break above 24, we'd come back to 20. Quick visit, just boom, right back above, and just immediately back to 24,000 and above now. We almost got up to 28,000 on the high already, which is the wave 5 target. Yeah, this needs to settle down too. And why is this going on? And it's just so ironic to start to think of, is money running into digital currency because of the fear of what's going on in the traditional finance and banking sector? It's really interesting, isn't it? I know we had the halving, we talked about all that. We had a whole session on it, et cetera. Around April of next year, we are starting to get into that time frame where you would expect some sort of a rally, but not like this. This has been certainly exacerbated by everything else, but just, the irony is amazing to me. And so almost to 28,000, let's calm down a bit. We're way above the 10-day moving average, but how constructive it would be if we could hold above 24,000 this time. We tried in the middle of February here and couldn't do it, fell back. Can it hold this time and legitimately run up towards 28,000 and then potentially beyond? But haven't seen that kind of moves in the crypto world in a while. I mean, something similar to that happened back in January, but not quite this severe. But certainly been wild watching that. I know Zach's been cheering on his Ethereum through all this. But it just, can we hold above 24,000 is going to be the key. I just couldn't resist the commentary and the irony of what's been going on here compared to what's been going on everywhere else. So let's look at some of the international markets and see how they're faring in all this craziness. And there's the EWA. What did we talk about last week? Likely coming down to that wave 4, right? That's what we said. Go back and watch the recording. These are all posted. You can see what we talked about. It's the wave 5 ended. We couldn't hold 24. We couldn't hold 23. So we're coming down to 22 to retest that wave 4 low. That's what happens when wave 5 ends. You retrace back to the previous 4. And there we are. Still oversold. So this bounce here doesn't really mean anything other than it was an oversold bounce after hitting the exact target that it should have, with the wave 5 ending and to move back to the previous 4. So that bounce is really meaningless, other than it's better than breaking lower, because once again, if we can't hold the 22 level, there's nothing in the way before going down and testing those October lows, which could very well come into be if the 22 level doesn't hold, but it could. And this is what you want right here. What occurred at the end of December, you'd like to see that happen here. This consolidate a bit here on top of 22 so that we can build some energy and momentum to take another run back to the upside. That's what it needs to do that. You don't want to see a quick snapback because those don't hold. We want to see, it doesn't have to go through this consolidation. I like it better when it does. It could just be a slow climb back up, which makes you wonder with the volatility if that's really possible. That would be okay. That could hold. This consolidation with a rally could hold, but a vertical snapback probably won't hold. So you don't want to see that. And then looking at Canada, friends to the north here in the US, and they're like, hey, what you guys do? We were really trying hard to hold the 34 level, and then look what's happened. You just blew us down to now coming down to the previous 4 there, because if 34 couldn't hold, probably coming down to the previous 4 in the EWC, and we got within a stone's throw of it. Didn't quite touch the line. Usually those lines get touched, so that makes you a little bit nervous. Haven't quite touched it yet. Is there a little more to the downside to go? Perhaps. We didn't quite make it, and we also have this zigzag pattern here that's set up on the EWC, and we're right there at that 100% level. We talked about that before. A viewer said, hey, is there a zigzag there? And there is. And I think I made the comment that there's the 100% extension. It would be hard to imagine that would hold without coming down to the previous 4. So far it has. I still think that would be hard to imagine that we're going to stop that close to it. Maybe we do, because there is some consolidation through here. Maybe it doesn't quite hit where the previous 4 is. Perhaps that's close enough. But more often than not, those levels are actually touched. Maybe, from a bullish standpoint, hopefully that was it. And we kind of start a slow, steady climb back to the upside. We just don't want big, massive rally back. We want to lick our wounds a little bit here and slowly build back into climb back to the upside. That's going to be the best case scenario. Let's see what India is doing. And there we are with labeled the wave 5. So we came down and broke that wave 3 low. And the question just is, how far do we go to the downside? We got a bit oversold yesterday, consolidation kind of today. Really hard to imagine that we don't come down and hit this wave 5 here around 37.5. That's probably where we're going in the INDA. It's nice that we're holding here in the area of the wave 3 low. We did break it because we labeled the 5, but it just seems that this consolidation is because we're oversold. We consolidate there a little bit and then drift on down to that wave 5. Kind of think that's what's likely to happen there. Germany, we've talked about how it's been one of the stronger markets, and it still is. I mean, it did have a little bit of a blip yesterday, but hanging in there pretty darn well considering everything else that's been going on around the world. And there's that level at 27 that it needed to hold. It tried to break below it yesterday. I mean, we did close technically below it, but 26.95 is barely below it, so I don't think that counts. Anyway, it didn't matter because it was only one day. You know, you have to have a second day of follow through, a confirmation day. We didn't get that. Right back above 27. Hard to argue that the German market, as ugly as it's been for years, and we've well documented that, is probably one of the stronger global markets right now. And that's what happens when you're beat up. That's going to be one of the early places to turn and move back to the upside. And it's done that. But what you have to admire is that even after this big run, okay, and that, that's the oversold stuff running back to the upside, this holding that's gone on over the past few months is very constructive for potential further move to the upside, that we haven't turned around and given that back, especially when this move was fairly vertical. So the longer we can stay in this range and go sideways, the better chance this is that it holds. There's still a tiny bit of concern, I think, because that wave 4 run to the 5 was pretty vertical. We had that exact same scenario that happened in the INDA. It took some time, but then that vertical move got retraced. Let's hope that doesn't happen in the German market, that we stay here and continue to move to the upside. Just have to keep that in the back of your mind, but I wouldn't worry about it. unless we break below 27. As long as we hold above 27, it's okay, but a break below 27, and I think we could see 25 in a relatively short period of time. Not there yet, just something to think about as you watch that market. So just absolute wild things going on globally around the world. And I'm sure there's going to be some interesting questions, energy stocks, et cetera. So I'll save those for the Q&A. One thing I wanted to show you, there's a commentary, but a real interesting trade that we have going on. And this, again, is what our trade detail looks like at ewotrader.com. This happens to be in the volatility portfolio, which is triangles and strangles. And so take a look at this. So here was the triangle on the original strangle that we sent out. And so there we are. There's the setup there on Bunge, B-U-N-G, Bungie, I'm not sure how you pronounce it, but B-U-N-G. And so there's the setup, moving into an earnings report right there. And then we get the break to the downside. And so I'm just going to go here and show you this adjustment that we did today because of the news. So here's the chart. And we're breaking to the downside here. You can see this nice move lower. And we were getting to the point where one of my rules is that you can take one leg off if taking that one leg off takes the risk out of the trade. In other words, you have enough gain or enough value in the one option. In this case, it'd be the put. You know, in a strangle, you're buying an out of the money call, an out of the money put. You can take one leg off if you have enough value in there to take the risk out. And then you just hold the other trade and see if you get a snapback. And if you do get a snapback from one of these vertical moves, then that's where the gain is. You have a risk-free trade at that point in time because you've taken the put off, you've covered the risk, there's no risk. You're holding a bit of a lottery ticket, we call it, in the other option. And if you can get a return move to the other direction, then everything that it gains is all profit from that point in time. We almost got there. We got within 20%. So we needed 20 more percent. And that scenario would have played out where we would have taken the put off. And then look at that move today. What happened? We're so close to getting ready, watching that on Friday, like, all right, or yesterday, watching it really close to say, okay, we can take this put off soon and then see what happens. And lo and behold, the news comes out today. BG is going to replace Signature Bank in the S&P 500 starting tomorrow. So that means any institution that covers the S&P has to buy the stock. So boom, back to the upside. So close. And so obviously you still have the call and the put. So the put that had gained a lot of value loses the majority of it. The call regains value. Now, what normally happens when you see a scenario like this and people think that, oh, wow, it's going to continue to rally. It's in the S&P. Everybody's buying the S&P. It's going to continue to go. I used to think that too. And, you know, you learn from things that you've observed over time, and you've observed a lot over 25 years watching the markets and trading. Been trading since 1996 and trading Elliott since 2001. Most of you probably know that already. But what normally happens when something like this occurs is you get this big move and then you go into a trading range. And that's what these lines represent. So what we did was go ahead and close out the strangle, take that off, because the likelihood of any sort of more volatile moves either direction is gone. And what normally happens is you just tend to go sideways. So we did where we often do put butterflies. In this case, you want to do a call butterfly because you had this big spike to the upside here in the call options because it was such a vertical move. The extra premium is there. So you put on a butterfly. And if BG stays in this trading range between these red lines now, we suck all that extra premium back out along with time decay, and we can generate a nice gain there. So even though the overall position is at a little bit of a loss now, after selling the strangle, we can gain that back plus some with the stock staying sideways here. And note that 105, kind of an odd place for that rally to end today, is also an area of resistance. So 110 is resistance, the next level resistance. 100 is certainly support. We're in between that. The 105 level has been support resistance for a while. Again, you know, you never know for sure. You put as many percentages in your favor as you can. But I thought that one was really interesting example to share with you on when crazy things happen out of the blue, and you never have any idea of exactly what's going on. So that's what happened so we sold the strangle for $235. So that wasn't so bad. And now we'll wait and see what happens with the butterfly and see if BG does indeed stay through here. So that's an adjustment to make when just something completely who knew that? Nobody knew that was going to happen. Up till yesterday, as Signature Bank was fine, and they were a member of the S&P 500. All of a sudden, they're failing. They got to get bailed out. They're kicked out of the S&P, and BG's next in line. And you get that's the way trading goes. Sometimes unknown things happen, and you just have to be able to adjust when something unexpected happens. So I thought that was something that you might have some interest in, and that's the kind of stuff that we share with our alert subscribers at EWTrader.com is how to handle things when this unusual stuff occurs. As you know, on TradeFinder, we do look for case study considerations, but when we identify them, we say, hey, here's a possibility. You're on your own, take it, do whatever you want with it, etc. But on the alert service, we send out alerts for entries, any adjustments and exits. So we kind of take you by the hand from start to finish on an alert. And especially when you have something really bizarre occur like that, where you're going from a stock that's clearly breaking to the downside to an immediate massive reversal in the other direction because of totally unexpected news coming out. Yeah, the unexpected, it happens in the markets. So got to be prepared for it. All right, let's go back and look at some previous case studies. We'll see if we can find one tonight. And then whatever time we have left, I knew this was going to be a long one. So I'm going to run through this really quick. We're actually not going to do a case study consideration tonight. I did take a quick glance because I knew I was going to be long-winded on everything else that was going on. And there's nothing. All the searches are zero. Even the consolidating stocks with the VIX up, we wouldn't do that. So we're just going to pass on that tonight. We'll just monitor these so that we can get to a few questions, because I imagine there's a few. But here was Alphabet when we look back at that on February 7th. And so it came back down, held 90 again. So here we are. As long as we can hold 90, stay with it. If it breaks 90, that's the exit. But as long as it can hold that, we're okay there. Apple is hung in there pretty well. So that's when we looked at Apple. We also have this as an alert for our alert subscribers at evotrader.com as well. Looking pretty good. Now, what we did here was we did an in-the-money debit spread, which is a way to counteract the craziness that's been going on for the last year or so in option pricing. And we'll do some education. You'll hear about that a little bit down the road. I think an in-the-money debit spread, the way it works, would be eye-opening for a lot of people. So we'll let you know when that educational information is going to come out. But that's what we did there. So as long as we stay above this level here in the 140, 150 range, that will do extremely well. But so far, you got to take some solace that Apple hasn't caved. There's an old adage that generals are the last to fall. Means that the big stocks, Apple, Google, Amazon, the big winners, the old FANG stocks, et cetera, when the market is really falling down, those are the last to fall. And when those go, then okay, it's time to throw in the towel. We're going down. We're going the other way. MPWR has just been absolutely wild to watch this one. I watched this one intraday, and it just, those bars don't look that big, but when you look over here, it's 500 to 520. So each one of those blocks is 20 points. So even though the intraday doesn't look extraordinarily volatile, it is. It's just, this stock will be up 15 points and then down 7 in 10 minutes. It's nuts to watch this throughout the day, but in the end, hanging in there really well. So, no harm, no foul, looking pretty good on this one. So I think you hang with this one too, even in this craziness. So far, wouldn't get rid of any of the ones that we're looking at. And then we did love. And remember, we looked at this and said, if there was follow through, we go short, and there was. And I think you take that one off now. So I think you call that one a winner on the strangle, you take it off, and that one's done. So we're crossing that one off the list. It's down here in an area where it could find some support. I think you might be asking a little bit much if you were in a strangle here and you stayed with this one and I could break it, but if it's going to bounce, it's going to bounce now. And you look at the 10-day moving average, and it's oversold. Now we could look at it, a week or two and it's down at 27. You say you got out too soon, but you make your decisions based on the information you have at the time, and you do your best on what information you have there. And for me, with it being oversold and at a potential support, time to go ahead and take that one. Looking at F5, another triangle that we looked at. And so there was the symmetrical triangle here. And this one was back on February 28th. Looked like a breakout to the upside, and there's one of those false breakouts. So it looked like it's going to break to the upside, and it came lower. And then the only thing we have to wonder now is the breakout really to the downside. There's no such thing as a double false breakout. In other words, you don't get one that breaks out falsely to the upside and then falsely to the downside as well. What can be occurring is a larger triangle formation, and that's possible that it really wasn't a symmetrical triangle. It's just a larger descending triangle that's being formed. And we'll find that out if it can't break below 135 and continues to go sideways here, then we'll know that was what was playing out. And while it's frustrating because you lose a little time decay while this is forming, I always tell our subscribers that on the flip side, though, you're building a larger triangle, which means that when it does break out, usually a more volatile breakout, and it makes up for that time decay that's lost in waiting. Amazon, another triangle, and gosh, you'd have to think, no, it's pretty good timing there, but man, hung in there. So we're still in the triangle, hasn't really moved. So if someone wanted to follow that one and hadn't put one on yet, still looks good, other than now the VIX is a lot higher. And so make the options a lot more expensive than they were before. And then that's it. So we got a few minutes left, Zach, and I apologize on the lack of a case study consideration tonight, but with everything going on and there's just nothing to look at on the searches, when you're in an area like this, this is the time where you put your hands on your knees and you watch, and you let the market tell you what's going to happen. And hopefully we get to where things calm down and we don't have any more shocks like we did with the banking sector, but you got to be nervous about it. Certainly, I would imagine. So fire away, Zach. Let's get as many as we can here in the next few minutes.
All right, sounds great. Yeah, thanks for a great presentation as always. And we'll start out here with a question from, well, it's actually more of a comment from Peter. Just a quick comment. That's exactly my question a week ago. Zig Zag to the downside on SBY, but it wasn't answered until Friday due to not enough time. And I understand. Looks like I saw it very well. Thanks to Rob's teaching and mentoring. It's easier to recognize it. Good reason to trust and to trade with it. Thank you, Rob, for sharing your knowledge with us. So
yeah, he's been around a while and he knows what he's looking at, and that was a really good spot on your part, Peter. So is it, help us with the pronunciation? Is it Peter? I've never been quite sure how to pronounce your name, and I want to get it right because I know you've been around with us for a very long time. And yeah, you were spot on with that downward zigzag, and to see that in an upward C wave extension is pretty weird. So good on you for spotting that. That was dead on correct.
Absolutely. And you also got some positive feedback here from Ren about the Friday live stream from last week through the Hub channel. So I just wanted to pass that through. And Ren would also like to look at Verizon.
Okay, let's take a look. You have to start wondering. We kind of speculated some of this on Thursday night of where places to hide. The stocks of McDonald's, Coca-Cola, those kind of stocks have been doing okay. You could look at something like Verizon. Are we going to get rid of our cell phones? We're addicted to them now. I don't think we're going to run out and get rid of our cell phones. So this is an interesting one to look at. So I understand it has been trending to the downside. If it's going to hold, it's going to hold right here. So I would say that if that's not in a 5-wave pattern, so it's in a corrective pattern, I would say if you wanted to be, and you have to look at it from a speculative standpoint because there's not a clear-cut pattern here. But when you look at the fact that we're sitting on support, you take into effect where's money going to go to hide? It's going to find defensive sectors. It's going to find places that people are still going to go to. We've always talked about the sin stocks, tobacco, alcohol, and gambling, the vices, the things that it's viewed accurately or not. You can make your own argument, but I'm just telling you the general view is that those are our vices. And no matter what's going on, we're going to figure out a way to drink, smoke, or gamble if that's one of your vices. And I would argue that we're addicted to our cell phones too. So I don't know that we're going to be getting rid of those. So I think if you want to take a speculative shot, not a bad place to go hide in a stock like Verizon either. So I great on you for whoever suggested that one's good spot. Now, one last caveat: if it breaks 36, you got to get out, because that Katie bar the door. If it breaks 36, then it's look out below. Hard to imagine it would, but if it did, yeah, you got to run then. So speculative long right now makes sense.
Alrighty, we have a request here for Baba.
Oh yeah, that it's going to be really interesting to see how this plays into the China stocks, doesn't it? With the emergence there, and then there's all this speculation back and forth of China saying that we don't want to be trading partners with them anymore, and our commerce people saying, yeah, we do, and there's all this bickering and stuff going on back and forth. You've got a wave 4 here at 66%, so it's just past the 61.8% level. Some support through here. I think the risk again here makes some sense. Some international exposure. China's coming out of what could be worse than a full-blown lockdown and everything, and is trying to hold here. I think this could be a speculative long as well. I don't think I'd be interested if it broke 80, because then it's going to come down and test 60. There's nothing in the way there, so I don't think you want to hold it quite that long. So as long as it can stay above 80, I think that's a good speculative long too. Good questions from our viewers, and good picking of which ones to ask, Zach. These are really good to look at.
Absolutely. Yeah, I thought that was certainly relevant. And the next one we'll go up to is Johnson & Johnson.
Yeah, I was going to look at J&J and AMAT were some that were sent in through support as would we look at those. And Johnson, you would think maybe this could be, but it's all tied in with all the COVID stuff and all that. So what you would normally view this as, a staple kind of company as far as a place to hide. It gets skewed with all of that. So this one's a little tougher for me. You got this wave 3 to the downside. It's trying to hold here in the 150 area. It did close above the 10-day moving average today. And so perhaps we're going to try to rebound up. It's got to get above 160 to get to that wave 4 target at 165. This would be, if you wanted to take a speculative shot at this one, it would be short term, I think. Potential bounce to 160, but I'm not confident that we don't go down to this wave 5 target here around 140, 145. So I have a little more trouble with that one. And I'm going to go ahead and do that AMAT one that was asked, Zach, so that I can make good on my promise to look at those. So let's take a look there. Obviously on the NASDAQ, Applied Materials, and as with the NASDAQ, looking pretty good. Nice move today. Got to really be impressed with this stock breaking above 120 today. And perhaps you give that one a shot, because it's to follow the rules, it needs another day. So if you can see tomorrow that we are going to be closing higher than the close today, so we're giving follow through on the break above 120, I think you could have something special there, but it has to do it. This one day doesn't mean anything. It's impressive, but things, it doesn't mean anything. We got a wave 5 exactly at 100% extension. Could that extend further? It could. So let's see tomorrow. If you're going to get a higher close tomorrow, I think that's a really good long. If it doesn't, totally different tune. So what happens with this tomorrow depends on my view on whether or not you would go long, or even wait for a potential short on a retracement back to the previous 4. As long as the NASDAQ is holding in there. Anyway, that I don't want to elaborate longer because we're running out of time. So back at you, Zach.
Next up, we'll go to Big Bad Tesla.
Oh yeah, you can't end any one of these broadcasts without looking at Tesla, and now you got to wonder. Everybody knows that this is a massively valued stock, right? People love it. People like Elon's vision. They're putting a premium into what else he could be doing. It's not just Tesla cars. It's there's an Elon brain premium here, I call it, and getting back and holding above 180 is really important, but it is in a wave 5 to the downside. So you have to take that into account. And so I'm cautious on Tesla right now, unless we break above this wave 4. So I know that's a long way away. It's almost at 220. You're like, that's a lot of room between 180 and 220. I just think that's a risk area. But if we could break above 220, then you've got a nice trade here. Because look at that stuff that is occurring there, all kinds of resistance, the wave 4. And if it can break above that level, there's nothing to stop it from testing the highs there from back in September, October. So I would encourage you to exercise a little patience here and see if we can break above that level first. I think it's a guessing game right now. And on the other end of the coin, it tried to break below 180. We got back above it, but if it did it again, the possibility, because it isn't a well-formed wave 5 to the downside, hard to imagine Tesla going down there, but it could. But getting back above 180 was very important today. And can it hold there? If it can stay there, then perhaps we can relabel this pattern. But until we do, to me, between 180 and 220 is no man's land. And so I just feel like we've got to get one of those levels broken. Go short if it breaks below 180, go long if it breaks below 220. I've said that before, and people have said, but it's going to probably bounce up to the resistance. Why wouldn't you make that trade? Well, I mean, if you know that, do it. I don't know that. I'm just saying that's the possibility. I think it's no man's land right here. So between 180 and 220 is tough for me on Tesla. Above 220, long, below 180 short. Right now, just watch.
All righty. Thanks, Rob. I see we're a minute after the hour, so you got time for one more?
Let's do one more. Yep.
All right. Let's wrap tonight up with USO.
Okay, I figured that was coming. Yeah, what's going on with oil? How is all this stuff affecting oil? Right when it got to 70, and it looked like, all right, here's the bid in oil. Things are okay. You look at this, as a sign of health in the economy, et cetera. Oil moving to the upside, and it just couldn't do it. It got there and it just right back down to 65. The key today, though, look at that. This is what I think we have to watch is 65 had held all the way since September, and it was broken today. So now we're back in that same scenario that we were looking at with applied materials. Do we get the follow through day? And if we do, I think that's a very negative sign for the economy. I think it shows potential further depth of a recession. Has to do it though, right? It has to make a lower close tomorrow. But if it does, watch out. And there's just a tiny bastion of support right where we are. And it needs to hold here. It did on the low, but barely. And I don't think you can go long oil now unless it gets back above 65. Again, downside trade. The unfortunate part is it's probably forecasting further economic weakness if that were to occur. So another one that we want to see tomorrow, what happens tomorrow? Can it get back above 65? Just to be clear, it doesn't have to get back above 65 tomorrow. It just has to have a higher close tomorrow to negate this break below 65. But if it makes another lower close tomorrow, probably more downside to go on oil, and I wouldn't look to go long oil unless it got back above 65 with a follow through. Thanks so much for your attention. Obviously a lot to talk about tonight, talk really fast, but appreciate it. Awesome questions as always, you guys. I say the same thing every time. Time's the most valuable asset we all have. We so appreciate when you devote your valuable time to us. We do our best to make it informative and educational. Thanks everybody. Take care. We'll see what happens the rest of the week. It can't be any wilder than it was last week, or maybe I shouldn't say that, knock on wood. Hopefully it's not, but we'll see. Take care, everybody.